What traders don't understand is that trading is just one big strategic game. Now, the market doesn't reward the people with the cleanest trend lines, it doesn't reward the people with the fanciest indicators, and it definitely doesn't reward the people that try the hardest. It rewards the people that understand what other people are doing before they even do it. Now, most new day traders don't see the markets as a game at all. They see it as a chart, a puzzle, a collection of patterns, and a science. But here's the truth. Those patterns that everyone loves so much, they are not signals, they are reaction. A chart is not showing you where price wants to go. A chart is showing you where traders are positioned. The market is human behavior visualized. Every candle is fear, regret, FOMO, and pain, all condensed into one vertical shape. Now, if trading really is a game, the question becomes, do you know the rules of the game you're playing? Because whether you realize it or not, you are playing, you're just playing it without knowing the rules, and that is why most traders lose. They understand incentive, they understand where money is positioned and how to move price into that money. They're not predicting, they are reacting to behavior, not candles. So in this video, I'm going to break down the game and make trading click for you in a way it may never have before. We are going to cover what game theory actually means when applied to trading, who the actual players in the market are, what each of these players wants and their incentives, the different market games that price goes through, and finally, how to consistently position yourself on the winning side of the market. Let's simplify game theory. Game theory is a study of how decisions change when multiple players influence each other. In a game, you don't just act based on your own goals, you act based on what you think other players are going to do around you. Now, let me give you some examples. In poker, you're not playing the cards, you're playing the people. In chess, you're not playing the board, you're playing the mind. And in sports, you're not playing the team, you're playing their tendencies. Now, let's translate that into trading. You're not trading the price, you're trading the behavior of the people that are interacting with that price. You're trading the guy that's buying the breakout because he's scared to miss the move, the person closing early because they're scared to lose their profits, the newbie placing their stop loss in the most obvious place, and the algorithm sweeping the lows before the actual moves. Now, you're trading human interaction. That's why two traders can interpret things on the charts completely different. Now, you're not trading the candles, you're trading the interpretation behind the candles. Once you stop asking, where is the market going, and you start asking, who is trapped in here and how are they going to be forced to exit? This is when you're going to see the markets in 3D, and this is where consistency will begin. Now, the first one is obviously retail traders. They are the biggest, not in terms of volume, but in terms of frequency. They are the guys chasing the big wins, putting their stops in the obvious places, fear of missing out, all this type of thing. Now, they are very predictable, and predictable becomes exploitable. Now, next is our large spectators. This is our banks, hedge funds, and institutions. Now, they need to enter enormous positions without making the market spike, disguise intention, accumulate quietly, and use ranges to build positions. Now, they engineer conditions to create liquidity. When price does something dramatic, sudden, or sharp, that is not randomness, that is bigger ball players fill in positions. Player 3 is the liquidity providers. They need to match trades, they need volume, they need your trades to match someone else's trades, and that is why they push price to where the most orders are. This is why price gravitates towards highs, lows, support and resistance, trend line, supply and demand. This is all liquidity. And what is liquidity? Liquidity in the market is fuel for the big ball players, banks, institutions, and hedge funds. Player 4 is the algorithms. They execute rules with no hesitation and no emotion. What they look for is imbalances, inefficiencies, order flow, and poor delivery zones. That's why when you see displacement, that is the algorithm saying, enough, let's move. Once you start seeing the players, you realize the market is not against you, it's just the players playing the game. The key to predicting behavior is knowing the incentive behind that behavior. So let's go player by player. Now, the retail trader's incentive is to avoid pain and chase comfort. This leads to buying out breakouts late, selling after the move is over, entering after confirmation, exiting when emotions spike. This is why retail traders lose consistently, not randomly. Large speculator incentive is to buy low and sell high without revealing they're actually doing it. Now, to do this, they need a fake direction, sweep highs and lows, create perfect setup to bait you as retail traders. Let retail traders provide liquidity. They don't chase price, they create the conditions that force others to chase the price. Next is the liquidity provider incentive. Their incentive is to fill orders efficiently. To do this, price is guided towards pools of liquidity like water flowing downhill. It's always going to be drawn towards, so prior highs, prior lows, this is not an option. This is mechanical system for how price actually moves within the markets. Now, this is my favorite one, and it's the algorithm incentive. It's to exploit inefficiencies. That is why price always sweep liquidity, expand aggressively, leave imbalance, retest the imbalance zones, and then continue. This is the same sequence across all markets, and believe it or not, timeframes as well. Markets are fractal. Once you understand incentives in the market, you no longer feel confused by what is actually happening. You'll start to say things like I do. Oh, that's just grabbing liquidity. Oh, now they're accumulating. Oh, guess what? Now they're displacing. This is giving me my direction. Clarity replaces confusion. Play the game. Now, I just thought I'd take this opportunity quickly to say, if you're enjoying my content and you want to learn more about what we do, I will leave the link below for my free mini course. It's very, very informative. So hit the link in the description below, and I hope to see you shortly. Now on to the games that the market plays. The market is not one environment. It rotates through 4 phases over and over and over again. Game 1 is accumulation. When it looks like nothing is happening, in reality, it's just a big ball players building positions. What does this look like? And the characteristics: equal highs, equal lows. And what does it do? It builds impatience. That is what the trap is. It is building and pulling out impatient traders. Game number 2 is the dreaded liquidity sweep. And what this does is it pulls out the FOMO emotion in most people. Now, you want to enter early because you've got a fear of missing out. What happens? Banks, institutions, hedge funds, all this sort of thing come back, sweep the low, takes your stop loss out, and then goes in the correct direction. Get rid of your FOMO. Number 3 is displacement. You want clean displacement with fast and sharp moves. Now, this is not where you want to get in. This is where you want to observe for your directional bias. Game number 4 is the mitigation. This is where price always comes back to the displacement. It very rarely goes breakout. It will always come back and retest. Once you learn to recognize the game you're in, trading becomes structured and very, very calm. Now, to actually enter, what you need to do is mark out your prior highs and prior lows. These are your liquidity targets. Wait for price to sweep either a high or a low. Look for a strong displacement in the opposing direction. Then you need to identify the imbalances that's left behind. Wait for price to return to the imbalance or the FVG. Enter with a stop below the sweep of the low or the high and target the opposing side liquidity. This is not guessing. This is not predicting. This is reacting to the market, and this is exactly what we want to be doing. Day trading is not random, it is not chaotic, and is definitely not out to get you. It's just a structured game with players, incentives, and repeating behavior patterns. Once you stop trading candles and start trading intent, your trading stops feeling emotional and you start feeling invincible. Now that you understand the game and the market participants, hit this link below to see real chart examples of exactly what I mean. Thank you for watching. Like, subscribe, and comment. I appreciate every single one of you, and I will see you on the actual examples video.